Picture this. Hard month at work. You're in bed. Email from payroll. It says you earn $2,000. Your bank account only gets $1,456. You scroll the stub. Federal income tax. State tax. Social Security. Medicare. Invisible forces took a bite, and somehow you're supposed to say thank you. That stub is the modern ritual of civilization collecting its fee. Most people feel the pain and never learn the vocabulary, so every raise, loan, and investment decision feels like a trap. This video is that vocabulary: taxes, banks, interest, inflation, recessions, credit, investing, value, and time, explained like a meme, not a textbook. Educational only. Not advice. Just the money language nobody taught you in school, before the next stub hits. Taxes are the cost of civilization. You pay. The government builds roads, funds schools, keeps your favorite taco truck from becoming a biology experiment, and occasionally sends expensive missiles to places you've never visited. Income tax hits money you make. Sales tax hits money you spend. Capital gains tax hits money your investments made while you slept. Nearly everyone also pays Social Security, forced retirement savings paid back later, and Medicare, health coverage for older people and serious illness. Filing is the fun part. The government often knows what you owe, then makes you guess. Right guess, fine. Wrong guess, documentaries. Annoying? Yes. Countries with higher tax rates often score higher on quality of life. The point isn't love. The point is, know which tax hits which dollar. You walk into a bank, hand over $1,000, and leave thinking it's sitting in a vault guarded by a dragon. Reality, most of it already left the building. Banks are matchmakers, not museums. Under fractional reserve banking, they keep a fraction on hand and lend the rest, maybe 900 of your 1,000, to someone buying a jet ski. The system assumes not everyone withdraws 100% at once, unless it's 2008, when everyone did, and the music stopped. Banks profit by lending your deposits at higher interest than they pay you. Supply is you. Demand is the borrower. Why deposit anyway? Cards beat cash. Interest pays you a little. And in the US, insurance typically covers up to $250,000 per person, so your shoebox is romantic, but not insured. Interest is why $1,000 borrowed can become $1,280 to repay. Lenders charge for the privilege of using their money now. On debt, especially credit cards, interest is a shredder attached to your future paychecks. On savings and investments, interest and returns are the unpaid employee that works overnight. Compounding is the time bomb that turns small, consistent gains into something that looks unfair later, the same math that ruins borrowers quietly builds owners. Hack is simple: if you're paying interest, kill high-rate debt fast. If you're earning it, feed it, leave it alone, and give it years. Interest is either your worst enemy or your best quiet worker. The only real choice is which side of the equation you're on, and most people accidentally pick both. You buy chips. Bag looks half-eaten. Price is 30% higher than last time. Congrats, inflation just mugged your purchasing power. Your $5 bill is still $5. It just buys fewer noodles and less gas. Causes vary: too much money chasing the same TVs, supply chain hiccups, or expectations. If everyone thinks prices will rise, they spend now and make it true. A little inflation, around 2%, is normal and even healthy. Spikes hurt savers and lag wages. Central banks fight hot inflation by raising rates, making loans expensive, cooling spending. Cash under a mattress is not neutral. Inflation is the silent tax on money that refuses to work, which is why beginners who only save in plain cash slowly lose the race without noticing. A recession is roughly 2/4 of shrinking economy. One day, job, bills paid, family trip planned. Next, layoffs, markets sliding, everyone saving for necessities. Triggers include high rates that choke borrowing, global shocks, war, pandemic, rogue container ship energy, or just the boom peak bust cycle doing its thing. Picture the economy as a party. Boom phase, dancing, drinks flowing. Then lights flicker. Someone checks their bank app. The DJ switches to sad lo-fi about corporate downsizing. Recessions aren't forever. They're painful resets. Governments may cut rates, send stimulus, or wait for people to buy overpriced coffee again. Spending returns. Businesses rebuild. Scars remain. Knowing the cycle exists beats pretending growth is a straight line forever. A credit score is a 3-digit shadow algorithm that knows your name, your past, and how many times you paid a card late in college. Range roughly 300 to 850. Below 580, walking red flag. Over 750, adult credibility sparkles. Most people live between 640 and 790. Drivers, payment history, the big one, credit utilization, age of accounts, mix of credit types, and new applications. Miss payments and the score poops on your life. Care for it and someday it helps you buy a house. Weird truth, zero debt can still mean a trash score if you have no history. The game is rigged. Learn the rules and you can play them back. It's less about being rich and more about looking trustworthy to lenders. Money is a shared belief. A dollar beats a stick because society agrees. Print too much, monopoly money. Too little, nobody can live. Central banks try to balance that tightrope. Investing is how you fight inflation so cash doesn't quietly die. Stocks, tiny slices of companies. Bonds, loans that pay interest. Funds, baskets so you don't pick one by one. Real estate, property someone else hopefully pays to use. Risk is real, markets go up and down. The bigger danger for most beginners isn't a temporary drop. It's never investing in watching inflation steal the future in slow motion. Diversify. Stay patient. Give compound growth decades, not weekends. Most wealthy people didn't win a lottery, they gave boring ownership enough time to look dramatic. Value is why a shiny yellow rock beats a normal rock to humans. Same physics. Different story. Create value, people want product, skill, service, and money follows. Doctors, lawyers, iPhones, even luxury bags price like rent. Perceived value is the pricing engine. Figure out how to create value, even perceived value, and you change your ceiling. Time is the scarcest asset. Almost everyone starts with a lot. Nobody gets unlimited. Most jobs trade hours for paychecks. Top earners train hours with skills and leverage. Nowhere does time work harder than investing. Wealth isn't built in days. It's built in decades. Ordinary paychecks plus consistency plus time become 7 figures, not by beating the system, by using it. A little money invested regularly, left alone long enough, becomes a lot of money. That was always the entire point. Taxes are civilization fees with many flavors. Banks lend your deposits. Interest is enemy or employee. Inflation silently taxes idle cash. Recessions reset parties. Credit scores measure trust. Money is belief. Investing puts money to work. Value and time build wealth. If this cleared the fog, you're on plain money. Comment which concept hit hardest: taxes, inflation, credit, or time. Subscribe for more unsexy money literacy without the guru flex. Educational only. Not financial advice. Learn the words. Then stop letting the paycheck stub be the only finance class you ever take.